the Midsummer's Day, tomorrow, 21st of June. Hard to believe already, Midsummer's Day. We kick off this Sunday morning with the week in review and oil markets closing at the end of last week, more or less where they started with it, but nonetheless rising. Let's kick off with Christoph Ruhl, regular Sunday morning commentator, senior research scholar at the Center of Global Energy Studies at Columbia University. Christoph, I suppose the big news last week amongst the different items to choose from was the Fed decision announcing ultimately a more hawkish position that they were going to have 2/4 percentage point rate rises in 2023. No surprise, yet surprised everyone. Your thoughts?
Well, what was the phrase, when Powell tried to pull a Greenspan and mimic him? He said, we talked about starting to talk, something like that. So
thinking about thinking.
Thinking about starting to think. Yeah. I think, as you said, it was long in coming because it has a serious side, of course, which it signals clearly that the Fed has to backpedal a little bit on its very optimistic expectations on generating a soft landing where you have continued strong growth and you absorb more and more people on the labor market without getting inflation, and then you start raising interest rates only once you really have sort of super full employment with everybody who can possibly walk having a job. That's not going to happen. I would expect the way the economy recovers, the way bottlenecks emerge, and also taking into account the international dimension of that problem, the different rates of growth in different places, and the damage higher rates of inflation can ultimately do to emerging markets. I would expect we will see more of this. This is really the beginning of tapering, and not tapering the interest rates, but tapering the talk about the interest rates, or the decision about the interest rates. We should watch whenever they are published, the dot plots, the contributions of the voting and the assessment of the individual monetary policy committee members. That gives us a further clue. But I would expect this to be the beginning of a more tighter approach, not the end of it. And one has to give it to them so far. The messaging that everything is under control has worked. And now they have to, as I said, backpedal a little bit. And through that first announcement, it has also worked. Markets say, okay, inevitably it will come and we get upset, but it's a good way to prepare them very long time ahead. And markets didn't go crazy about the announcement.
Yes, the market certainly didn't go crazy. Let's bring in Dr. Sarah Veshkuri, who's the founder and president of SVB Energy International, a strategic energy consulting firm based in Washington, D.C. Dr. Veshkuri has a PhD in energy security and originally hails from Iran and a bit of an Iran expert in that regard. So it's good timing, Dr. Sarah, to have you on the show, especially the day after it has been announced without too much surprise, but there is a new Iranian president demonstrating a return of what they call, in the language of Iranian watching, a hardliner. Your thoughts on the result and what it might mean for the energy markets?
Thank you for having me, Sean. I remember last time we were discussing, we also referred to this, and the results were pretty expected. We were expecting it was not really a hard election to anticipate the result of the election. And simply, as you mentioned, the president is among the hardliners in Iran. And of course, as again, referring to what we discussed in the past previous time together, there are expectations that nuclear negotiations is still move forward and going on. And as long as there is not serious pressures on Iran's missile program or expectations to that Iran should backdraw from its support for proxies, the negotiations may go on and on. But obviously, the hardliners have less incentives to do the negotiations as President Rouhani had. They are the ones that formed that massive economic deal with China. That part of that is China's commitment to purchase or take Iranian oil in return for all of those goods and investment that have been signed in that long-term 25-year agreement between the two countries. So they are, even if the negotiations move forward and even if there's a negotiation sanctions unwind, we expect that China would have a stronger presence under the current president in Iran, instead of, let's say, hopes for Western companies to enter Iran. And the deal between Iran and China, the 25-year deal, is what Iran and the current president hardliners are hoping that will help Iran to export more oil if there is sanctions or not sanctions, just basically a trade with one country to sell oil in return for what they need for their economy.
Dr. Sarah, your clients, American companies who might be looking to return to the US or to Iran, do you think there is an appetite, even if the deal is done, so to speak, given what happened last time, the uncertainty about the American commitment?
This is a very good question. To make it clear about American companies, we are one of them. There is not much appetite in terms of investment. Obviously, American companies have additional primary sanctions that they don't expect those being removed with the nuclear negotiations, or if there is any positive end to that, they were not removed back in 2016. So American companies in particular will not be easily able to invest in Iran. And I remember back in 2016, Sean, some of the major investors and major companies in energy, US companies, were saying that Iran does not have a clear understanding of a current market environment. So simply there's not enough incentives, even if there was no sanctions. But going to European companies, other Western companies, particularly larger energy companies, the appetite is very low at this time, because they are not ready to commit for a long-term investment in Iran, unless they are sure that at least the next US president will have the similar approach as this current president, even if next president is the same President Biden, but they just want to make sure that the approach is same toward Iran. But on the short cycle trades, especially trade with Iran, yes, there are appetites for doing short-term trades or selling goods, selling services, that the return of investment or the return of business is very short cycle and very much certain, rather than long-term investment.
Christoph, we saw this week after the Fed meeting and the announcement, shares in what they call value stocks, banks, energy companies, and others, those who tend to perform well when the economic growth outlook is very positive. They have had a serious sort of pullback on the back of this Fed news. What's your interpretation of that? And given that oil prices held firmly, but yet value stocks have taken a hit, indicating that the outlook sentiment may have shifted.
Yeah, I wouldn't pay too much attention to it. I mean, just look where we come from. We come from this enormous sort of recovery from the COVID shock, but it was, of course, uneven. You know, we had especially tech stocks moving ahead, you know, going up on average, I don't know, 200-300% since April, many of them at least. And then you had others catching up, and so you have this general sentiment shifting, you know, from growth stocks then to value stocks. And the next thing people were expecting was dividend stocks, of all things. Now, with the Fed sort of indicating that there is a braking pedal somewhere down there, this has been stopped a little bit, but I think the general trend would continue. So the part of the hope of engineering a soft landing in financial markets is obviously the stock market, and part of the hope of engineering it in stock markets has to be to continue the situation which we had for the last few months, where the tech stocks, which were running way ahead, are no longer aggressively gaining in value, and others are still catching up, so that you don't have the overall picture of a declining market, but of stagnant or a growing market, but a rebalancing internally of those parts which have run ahead. I think again that will continue, and obviously both for valuation reasons and for growth reasons or expected growth reasons, when the perception is that the interest rate comes earlier than expected, and the assumption is that this will badly affect growth, and then those stocks which had run ahead of the pack and the growth stocks will suffer first. That is pretty clear. But I think we are in a market where if there will be a violent reaction at some point, which doesn't necessarily need to be triggered by the Fed, but if it comes at some point, it will be very hard to find a place where you can hide. So that will affect everybody. I think that's the kind of market where we are. There's great correlation across the different asset classes by now.
When you consider the current this cycle or this particular moment coming out of COVID, all of the stimulus, etc., inflation currently at least guiding around 5% in the US. The management of this moment has sort of unprecedented in the sense that we've never had so much debt, right? About personally, corporate, sovereign. And so any incremental increase in the interest rate has such a much bigger consequence. I'm just wondering if you could speak to that at this moment, what kind of challenge that adds to the Fed's sort of soft landing.
This is absolutely correct. So we have a picture which, when you think of it from begin with economic policy, then you have always three choices, and you may use one of them or two of them or three of them. One is monetary policy. Basically, is you make liquidity available, you keep interest rates high, you hope that this feeds into real growth and transactions. The second is fiscal policy. Basically, you try to govern the government to step in and to spend money on infrastructure, on transfer payments, on whatever, in order to increase demand. And the third one is structural policy, which means that you deregulate, that you put people on their own, that you remove obstacles to investment and regulation and all these kind of things. That's third one, in theory, is the one preferred by Republicans. And the first two one, if you can say it so simply, is more preferred by Democrats. What we have now systematically for a long time is really monetary policy going to extremes, creating an environment of low interest rates for a length of time, which I think is unprecedented by now. Negative real interest rates all along, making money available, though sort of the bonfire is stoked from that side for inflation. What we also had is fiscal policy now for a while, which was held in check, funnily enough, by Democrats, but then it was loosened by Trump and his tax reforms. So the roles were reversed, and now Biden goes all out on fiscal policy. And structural policy, the hard stuff, telling people, okay, we don't raise the minimum wage here, there's no shelter, we deregulate, we make it more competitive, tackling companies, in their attempts to control markets. That hasn't been touched at all. In my eyes, that would be the thing, especially in Europe, which would unleash growth, or in China also to some extent, but that hasn't happened yet. So we rely on these two things, and they are, of course, the classical mixture for inflation, in the sense that the government spends more than it earns, and at some point starts to finance it with the very money created by the central bank. And that will go into assets first and prices second in modern times. Now, what we are seeing is, and you're perfectly right, as a background to all of this, and because it has gone on for so long to deficit financing and money creation, as unprecedented debt levels. In the rich countries, we are now about 300% of GDP for the group of well-performing developed economies. And this is record debt levels for the government, for the private sector, the corporate sector, and for the households, all three of them. And that means that when you have now a situation in which interest rates increase, sooner or later they must, then the weakest in this huge pile of indebted people will be the first ones to suffer and start to default on some loans. Some, junk bonds will not be paying. And that is exactly the kind of stuff which can trigger this debt creation, debt spiral throughout the financial markets and usher in a crisis. So
even the talking about talking could start to push the first dominoes on that.
Yes, this is a matter when the first dominoes fall and then you don't intervene in time, you see the house coming down if you're unlucky. And we are so focused on the inflation picture. But what is really going on for the Fed's point of view, of course, is that the medicine against inflation, the raising of interest rates, the slowing of growth, and so on, is exactly the kind of match which could lit the bonfire of a financial crisis. So there's this cross current, and they have to avoid it at all costs. And that's why it is sensible from their perspective to start talking years ahead, of a possible meeting to possibly discuss, possibly touching interest rates and all that. That's where this comes from, because the world isn't so simple anymore. You can't just say, okay, sorry guys, we need a 2-year recession in order to avoid 10% inflation. You, by talking about that, create the conditions for a financial crisis. And one final point, and this is where it gets really worrisome. It's not only the Fed trying to go between Scylla and Charybdis, avoid inflation and also a financial crisis with their interest rate policy. It is also that this debt level is so real that it is completely unclear, to me at least, but also to the Congressional Budget Office, for example, in their forecasts, how it's ever being repaid. Right? This is the real problem. So you have some loonies out there among the growing sect, among economists, talk about the money tree, who said, debt can always be there and we can just roll it over. We never need to repay it. Governments don't need to repay it, which blatantly is just wrong arithmetics. You can't roll it over forever. When interest rates go up, it gets more expensive to do that. And then others, the rest of the world doesn't know how to repay it. And this is the ground, the fertile ground for politicians coming out saying, okay, let's have 5%, 4%, 7% inflation. That's not going to kill anyone, but of course it inflates the debt away. When you have an inflationary situation, creditors lose. And so
there's also that I think embedded in that sort of longer term, maybe disguised policy at the moment is the desire by Biden administration to see labor costs or incomes rise, even if it's inflated. Let's just move, Sarah. I wanted to get your thoughts on the. Last time we had you on, we were talking a bit about Iranian oil supply. It obviously has had a sort of a big surge over the course of 6 months, sort of from the fourth quarter into the first quarter, but it seems to have kind of plateaued. What's your sense of where Iranian oil exports and the outlook? Because there was a period in which they were providing a downward pressure on the oil price. It doesn't seem to be the case anymore.
That's a good topic to discuss, Sean. Yes, when President Biden was elected, Iranian exporters start to rise, but it not only plateaued, start to decreasing, and in previous month, even in the current month up to now, Iranian export have shown decrease month to month. The downward pressure, though, I would argue, was mostly from markets' expectation that the nuclear talk will end in a positive result soon, and Iranian oil will be back in the market soon. And the market, obviously, as we are moving toward the end of 2021, toward the second half, and then the last quarter, the demand is continuously increasing, and market has been in a deficit from February. The global inventories are almost at the hit the 5-year average. So the market this year, by the end of the year, is going to have about 1 to 1.5 million barrels per day of deficit. So having Iranian oil back into the market could be absorbed by the demand if it moves forward to the second half and the last quarter of 2021. But previously, if the market wanted to expect Iranian oil to be back in the market by first quarter or the second quarter, was not ready. So that psychological impact, downward impact of Iranian oil return on the market was more serious as we are moving to the second half of 2021. Also, having again a hardliner president kind of postpones or delays that expectation of having rapidly Iranian oil coming back to the market in a unlimited export capacity, which means like all the sanctions being removed immediately upon any negotiations result.
Sarah, we have in the digest today an article about the relationship between Iran and the Gulf Arab states on the back of this new president and the return, if you like, of the hardliners. Again, it seems they're all relatively hard on some level, but nonetheless, the sort of a more harder version. But the UAE were very quick to congratulate the new president, to sort of do the normal diplomatic gesture of acknowledging. How would you interpret this the relationship going forward with this new administration, the Gulf Arab states on one side and the Iranian new government on the other?
When we're talking about the Gulf Arab states, it depends very much country to country. As you said, for instance, UAE was very quick to congratulate the president. Saudi Arabia or Bahrain, not yet. So what I would say is that UAE, obviously, they have some disagreement with Iran, but they always contain that diplomatic positive gesture and relation with Iran. But when it comes, for instance, to Saudi Arabia, things are different. There is a serious and significant lack of trust between Iran and Saudi Arabia. And unless there are strong gestures of trust building from Iran, this trust is not going to be built. And there were obviously discussions about the direct talks and negotiations between Iran and Saudi Arabia, but we did not expect to go beyond the national security issues of two countries over the conflict in Yemen. So obviously containing the security of the regions, preventing another tanker war or attack or conflict in the regions. National security issues would be a topic that countries like Saudi Arabia, also UAE, would be in communication with Iran. But moving beyond that, it's at this point, even under Rouhani administration, the trust between Iran and these countries is really needs to be built and worked on that. Simply, they cannot trust Iran's intentions, especially when it comes to Iran's missile program and support for proxies. These are the issues that major countries in the in this whole group that you mentioned, particularly Saudi Arabia, have and UAE have issues with that.
Let's go to the survey question this morning and give everybody in the room a chance to express their thoughts on the Fed decision. The question I asked Christoph earlier, shares of banks, energy firms and other companies that tend to be sensitive to economies and fluctuations have tumbled following the Fed's meeting on Wednesday. My question is, have we seen the 2021 high for oil prices? If indeed this does signal the end of the, at least the end of the beginning or some version thereof, have we seen the 2021 high for oil prices, which on Brent popped briefly above $75 last week, but didn't close there? So your thoughts, yes or no, on that question? And we'll go to Christoph and Sarah about the week ahead and what they might be watching for. Christoph, your thoughts week ahead. We had in our digest also more updates on the U.S. production incrementally increasing, but no significant return of shale now would appear this year, at least according to OPEC. Your thoughts week ahead?
So this is exactly, I wanted to go away from the macro and go a bit closer to oil, because this is not only about Iran coming back. And I think in the current demand picture, the standard assumption of Iran getting back, 3 months for 600,000 and then in half a year, maybe 1.2 million barrels per day, that can be absorbed by the market because there is this very strange gap at the moment left by shale. And this is really an important question. So why was shale so slow in returning? By now, with oil above 70 and months in the making, we should have seen a response. We didn't. And the more I sort of ask all my American friends about this in the oil patch, I get two answers crystallize themselves. So the conspiracy theory is not among them, and the cold winter is also fading in importance. One is that it is indeed sort of companies being slow because they want to make sure that they will repay their investors first. So it's still part of this ongoing financial restructuring. That would be a pure delay, after which you would expect companies to come back even stronger, more consolidated and more settled businesses. The other is that it is to do with all this ESG funding and all this talk about the energy transition, and those shall not invest into dirty oil. There's no future for it, and we will restrict drilling rights further. We will tighten regulations. All this kind of noise the Biden administration has made excessively. And there, it's interesting, there they're actually backpedaling a little bit, because gasoline prices now in the US are very expensive, have risen to $3 or whatever this threshold is. And all of a sudden, sort of the energy minister in the US, she's no longer talking about only renewables and she said literally verbatim, if you wouldn't be worried about gasoline prices if you had bought an electric car. And she was called back on that, and now she is talking about how high gasoline prices are bad for the future. So in the microcosm, you can see what happens. What I would expect to happen on many fronts of the energy transition, politicians sort of starting with big promises and then backpedaling under the pressure of the electorate. And both of these signs point to me that shale, of course, is not dead and will come back. And then when you look at the calculations when that would be, if the rig, taking into account the rig count and the usual 6 months delay from rigs to hydrocarbons start flowing, that would all bunch up in the first quarter of 22. And when I listen to Sarah and others on Iran, they're clearly playing a long game now, and there will clearly be another round of discussions back and forth in the US saying we need to decide now. It's just saying that they lost this round and have to wait a little longer. That also might indicate first quarter of 22. So that's then going to be an interesting time of potential volatility. And I indicated this earlier, and I'm going to make the hint again in this sentence. One way is out for a big organization in the way of being very OPEC is in combating something like shale, is to increase financing costs, make the capital costs more expensive. You do that by creating volatility. If those guys who are now installing these sound financial systems on the shale sector suddenly get scared that these are risky bets on an oil price which can crash as soon as it goes up, that would make financing more expensive. That may hold shale back a little longer and more effectively than a continuous run up in prices. So I would expect this run up and then some volatility.
Let's bring the survey question in a result and see where we're at. Have we seen the 2021 high for oil prices? 2-1, no. The bullishness in the room. Dr. Sarah, we're now looking the week ahead and obviously the month ahead. We're in this sort of interim period between the election and the new president in Iran taking office. Is this a period, you think, in which actually a deal can still be done with the P5, US and Germany, which is part of that group, or is this a dead duck period and nothing can happen till the new president comes in? What's your own outlook?
Well, I would say the new president and his teams are master of surviving under negotiations. So as long as these negotiations goes forever, still Iran wins, because having ongoing negotiations of obviously result is good, no sanctions is better, but ongoing forever negotiations is something that also could be considered as a win game for some of the Iranian power centers, is better than harder sanctions or harder approach that President Trump had. But I'd like to add something to Christoph said. It was a very interesting point about how shale producers are not expected to cover that gap very fast. This is very interesting because since the beginning of pandemic, we have been in regular discussions with major shale producers in the US. And what we have learned is that they are really capital disciplined in terms of particularly investing on those marginal wells that are higher cost, and their production is highly dependent on a higher cost, higher oil prices. So they are mostly focused in more budgeted wells, those wells that could survive in medium to higher oil prices, but they are not going to invest so much rapidly on those marginal investment on those marginal wells that they require higher oil prices to survive the production. So what we see, as Christoph said, traditionally it would take 6 months for US shale production to kick in and show its reaction to the prices. We are expecting now to be delayed to about 12 months. So the discipline that and the lesson that shale producers have learned from the oil prices moving 3 times, they hit the 3 oil shocks, is that they have to be more conservative when it comes to the wells and locations they are choosing to drill. Also, obviously, the long-term impact of all those energy transitions on the investors and creditors and how much they are ready to allocate investment to the shale producers. Obviously, they need to see higher oil prices for longer months to come. So the price elasticity of shale producers toward higher oil prices have changed, and that's a new factor that is really going to have impact on the market when we are thinking that how fast and how much shale is going to come back to the market and cover the gap.
Christoph, just a quick final word. One of the big consequences last week of the Fed decision was to see the dollar strengthen. What's your outlook for that, the consequences of that if we do see a sort of a turn to the dollar to the stronger side?
Just one very quick correction to what Sarah said. So I didn't mean to imply that there's certainly no level problem. Level of oil prices is high enough for all the shale in the world to return. So they are, the Dallas Fed says they're below 50 on average for break even. So it's a delay problem for this specific situation. No, it's not that suddenly the reservation has increased. On the dollar, I am separating myself from the current opinion is that the dollar will weaken. I never quite understood this argument. In my book, the Fed signals that they will be first in going ahead to raise interest rates, and that will make the dollar more attractive. If there's a risk of volatility, that will make the dollar more attractive. If they succeed with the soft landing, that will make the US more faster growing than Europe and others. So in my book, yes, the dollar has weakened considerably already, and I see it the other way around. I think that the dollar will strengthen.
Interesting. Okay, well, let's wrap it up there. Christoph Ruhl, as always, on a Sunday morning. Thank you very much, Dr. Sarah, on a Saturday night in Washington D.C. when all are asleep. We appreciate you being with us, and we'll have to keep an eye on where this story goes in Iran and the talks in Vienna, which of course are now suspended, I believe, till July 1st. We'll catch up with everybody during the week, every morning, 10:30 UAE time. All the best and have a great week. Thank you.